Today, I want to show you some information to teach you how to read your law firm's financial statements. Today, the three things I want to cover are looking at your payroll, whether it's healthy or if it's jeopardizing your firm's financial health. I want to look at your owner's compensation, and I want to look at your WIP. So let's dive in. Now, the numbers you're going to see today, completely fake financial information. Saul Goodman and Associates, we all know who that is. So completely fake information, but I had to provide some information to be able to demonstrate what I want to talk to you about today. So this profit and loss statement, we're going to start with your payroll. How would we look at your payroll? Okay, your people cost. I commonly refer to this as people cost. And so this is Saul's profit and loss for the full year of 2025. And I've highlighted several numbers. And notice how they're not grouped side by side within the P&L. And that is for different reasons. So I'm trying to pull out the items that represent what it costs you to have employees. So within this situation, now I will tell you, your firm may have something a little bit different. You may have other benefits. So Saul is paying health insurance for his employees. He has payroll tax. He has wages for his employees. And he has a 401k retirement plan where he matches a portion of employee contributions. Now, your firm may not have a retirement plan. You may not pay employee health insurance. Or maybe you have other benefits. Maybe you're in a large city and you provide a benefit for your employees' transportation costs, either parking or bus passes, subway, or there's just so many other benefits. I can't even go through all of them. But again, this is just an example. So when I'm looking at people cost, my goal when I talk to my clients is I want your total people cost. So how much does it cost you to have your employees? I want your goal to be 30 to 50% of your annual revenue. Now make sure that when you're looking at this, you're looking at your annual costs in comparison to annual revenue. That's the big key. It's making sure that the time frame for all the numbers involved when you're doing this analysis are the same time period. So you could do this on a monthly basis. So you could look at all of these, and if these numbers represented your monthly costs and this was your total revenue for 1 month, then you would have a valid percentage. So just make sure that the time period you're looking at is the same for all of these numbers. And then review your profit and loss. So I went through this and just scanned through and said, oh, I only have this cost because I have employees. And I only have this cost because I have employees. And I have this cost because I have employees. And this cost because I have employees. Now, notice that I did not include professional liability insurance. I don't consider that a people cost. That's just a whole other separate issue. You're going to have professional liability insurance for your either your partners, your associates, but not for every single employee. If you've grown beyond just you, and I'm pretty comfortable that you're going to have some type of admin in this number. So I want to make sure that the costs that we're looking at are just the costs for all employees. Okay. Costs that impact all employees. These couple of accounts that I have highlighted in yellow, I pulled those over here. So these are the exact same numbers, but I'm just condensing it in this middle section here, or the section over to the right, just trying to condense it so that I can do some math. So I pulled over employee health insurance, payroll tax, wages, and then the employer match on the retirement plan. When I add these up, I get $1,140,703.48. Total revenue, I'm just taking that from up here. So it can either be called revenue, gross revenue, income, or gross income. Okay, so it's the top line revenue, top line income. So it's the top income number. So right here. So that's the same number. And so this ratio now I'm going to look at, and it's just the total cost divided by revenue. And in this example, the percentage result is 43%. And that is within my goal of 30 to 50%. And I probably should have clarified of total revenue. So in this situation, this is good. If the total cost, if these wages went up, or if any of the numbers in here were higher than 50%, I'm personally, as a fractional CFO, I'm concerned because you're leaving less money from your revenue to pay for your overhead and to put profit in your pocket as a law firm owner. Now, years ago, I used to be very, I don't want to say heavy handed, but I would caution firm owners, do not go above like 35%. And it started to weigh heavy on my heart because I want to make sure that you're adequately and properly compensating your employees. And compensation includes the benefits that they receive. Over the years, I have had clients where a handful of employees voiced concern that they were underpaid. And based on what I knew about their wages, they were actually, because I see it from a different perspective, being a fractional CFO, I have multiple clients. So I can see payroll for multiple law firms of different sizes, different areas of the country, different types of practice areas and all that. And I had one client in particular that a few employees had come to me and said, and started asking me questions. I'm like, first off, I really cannot share that information with you, but here's what I can tell you. You are not considering that your compensation includes a very generous 401k match. It was 5%. The employee health insurance was 100% firm paid. Those two things alone, and they had some other like minor benefits, but those two things alone, I'm like, I don't know any company, and actually be happy with the size of this firm that they're paying your health insurance, because it was under 50 employees. And I don't know if that's still the rule, but I know for a long time, at least when this happened, the law was 50 or above employees, you have to provide employer provided health insurance, but under 50, you don't. And yet this firm went above and beyond and was paying 100% of the health insurance premiums for its employees. And then most retirement plans that I have seen over the years usually match at like 3% of contributions up to a dollar limit. This was 5%. So I had recommended to this firm, I said, hey, I think every January it would be very helpful to calm down some things going on in the firm, some talk, if you put together a letter that laid out for each employee. Now, this was a little bit time intensive to gather this information, but pull together this information that I have here, but pull it together on a per person basis and provide a letter to each employee to show them what their numbers are to get to a total. Not to show them this piece, the total revenue or the percentage of revenue. They don't need to know that. But I was trying to demonstrate to the employees that they actually receive a lot more compensation just because they don't see it in their paycheck. If they took a comparable job making, even if they just made maybe $5,000 more in salary, it would actually be a pay cut because they would either have no health insurance or they would have to pay so much towards their health insurance that it would be a negative to them. And then their employer match was less, so they would lose money there as well. So that's just something to think about. But again, if your goal should be 30 to 50% of total revenue that you're paying towards your people cost. So if you have any questions about this, drop them in the comments below. Let's move on to owner's comp. Okay, so we're back to Saul Goodman, and this is now Saul's balance sheet. And we're looking at December 31st, 2025 and versus December 31st, 2024. Now on your P&L, the numbers that you see on your P&L are the sum total for that period of time. So let me just flip back. So on here, this is the time period, January 1st, 25 to December 31st, 25. So all these numbers are all transactions for this time period. Your balance sheet works a little differently. Balance sheet, the number is as of a point in time. So at the end of the day, December 31st, 25, that was the number. And at the end of the day, December 31st, 24, this was the number. And then it goes through and lists out what the firm owns. And then it lists out what the firm owes. And the difference between those two is your equity. And so I want to focus on equity. Now, one thing that I do want to note, so again, we're talking about owner's compensation. And Saul Goodman, the way that I have this set of financial setup, he is set up as a single member LLC. He is not taxed as an S Corp. He did not make that election. These numbers would look different. And I pointed that out because I wanted to make sure that we're very clear. If Saul Goodman had made the S Corp election, then he wouldn't have employee health insurance, but he would have owner provided health insurance, and it would be included in his wages. There would be payroll tax. He would have a W-2 paycheck, and he would get an employer match on his contributions. In addition to all of these, he would have owner distributions. That's if, so these numbers would be populated if he made the S Corp election. I am a CPA. I am not your CPA, and I do not do taxes. Please don't quote me and all of a sudden turn this into Kelly said. So this is just an example of a single member LLC. The compensation in this situation is only going to be owner distributions. How do we find that number? Now, this is a weird number because it's not a number specifically on any financial statement. You have to do some math. But what I did here is if I look at the 25 at December 31st, 25, and then December 31st of 24, and then I added a column for the dollar change. So to get partner distributions, it's not the number you see this year at the end of the year. Because on a balance sheet, this number represents the sum total of life to date from day one of your firm, all the transactions for this specific account, ending as of the date that's for that column. Okay. So this number here, this $796,000 represents the sum total. So all distributions Saul has made from his firm from day one, regardless of when he started, doesn't matter if he's been in business 1 year, 10 years, 20 years, doesn't matter. From day one of his firm, he's taken out a total of almost $800,000 from his firm. To get your partner distributions or your owner's compensation for 1 year, it's the difference between last year and this year. So that's why I did this column here to show the change between the two numbers in over a period of 1 year. As of last year, he had only taken out $233,000 in distributions. So that now the difference between the $233,000 and the $796 is $563,000 in distributions. As a single member LLC, that's his total compensation from the law firm. And so that's where this number comes from, owner distributions. And the one thing that I like to look at, the goal here, it's not that there's a metric for this. I typically will tell people if you absolutely need a number, then aim for 30%, but don't go above 30%. And there's a reason for it. If you like percentages, if you think of percentages, or if you look at something as pie, if you look at your total revenue as a pie and you start pulling the pieces out, the pieces of the pie pieces, if you pay 30 to 50% of your pie towards your people cost, then aim for 30% or a third of the pie going towards overhead. And then that leaves the rest to you as the owner as profit. The bigger the piece of the pie is for your people cost, or the bigger the piece of the pie is for overhead, then that squeezes your owner's compensation, the profit piece. So there's a fine balance that you need to figure out for yourself. And it's different for everybody, which is why if you're going to press me for a number, I'm going to tell you the goal is up to 30%. Don't go higher than that, because you're going to start squeezing. You're going to put pressure on yourself between your people costs and your overhead. 21% is a very comfortable number, especially with these dollar amounts. So again, but I just want you to understand where this number is even coming from, because what this represents is this is all the money that Saul took out of his law firm that had he just took it as personal money. And that's his pay. That's his owner's compensation. So again, goal, there's no metric or goal, but aim for consistent and sustainable dollars. Now, if you took this out, so if Saul took out 500,000 on day one, he probably struggled the rest of the year to take out the remaining 63,000. I don't know, because we don't have the detail on this and I don't want to get too bogged down in the details, but making sure that your owner distributions are consistent. I don't want to see, I'm happy if you're in some type of a practice area where you bill on contingent basis. And I'm very excited for you if you have a very big judgment or a settlement and it becomes a windfall and you take out a substantial distribution. You won't be able to keep up with that. But my goal as a fractional CFO is I want to make sure that the law firm owners are taking enough money between distributions, and then if they are taxes and S corp, their wages. My goal is to make sure that they're consistently taking enough home each month to pay their personal obligations. So to fund whatever your lifestyle is. So to make sure that you have money to pay for your house and your car. If you want your spouse to not work, whatever that looks like. You want your kids in private school. You want to take 3 vacations a year. I don't care what your goals are or how you spend your money. My goal is I want to make sure that whatever money you need at home to have a thriving life, that your firm is creating that financial money for you to be able to fund your personal life. So again, looking at owner compensation, it's more about the consistency and sustainability. Where I see law firms get into trouble is when they're starting to borrow money, they're taking on debt in order to keep up with the distributions. It's a little crazy, but I have seen it. So that just becomes a very bad situation, because now you have debt to be able to pay, and I'm not sure that the firm can always take on some of the debt that they're given. Sometimes lenders are a little bit crazy. I have had some clients over the years, I thought there's no way, snowball's chance, that they would get anybody to lend them money. And then the next time I look at their financials, they borrowed money. And so then I've had others where I'm like, nope, financially strong. If you need to borrow money for growth, whatever that means for you, hire a new associate, open a new office, I'm positive that you'll be able to find a lender that would lend you that money. And then they struggle to find somebody. So I've seen it both ways, not expected, but just making sure that partner distributions are in check. You're not taking too much. You're leaving enough money in the firm for the firm to be financially stable, but also making sure that the money you're taking out leaves you personally stable at home. So that's owner's compensation. The last thing I want to talk about today is your WIP. Now, WIP is the abbreviation for work in progress. And essentially, this means all of your time tickets that have not yet been billed. Now, this, even though I want to talk about financial statements, this is something I wanted to talk about because you won't see it in a financial statement. WIP is not something that's tracked on your balance sheet or your P&L or your statement of cash flows. It's not in a financial statement, but depending on your billing system, you will have some type of a report that you can go to that will tell you the total of all time tickets that have been entered at this point that have not yet been billed. And these are all fake cases. And I did not get creative. I should have been a little bit more creative with the case names, but I wasn't. I didn't have time for that. But again, this is just an overview showing that for accounts receivable. So for these cases, in accounts receivable, this is how much money is sitting there in accounts receivable. Draft. Now, I took this out of my case. I'm not sure that I've ever seen money in this column, draft in progress. There may be situations, I don't know how to create that, but I just disregard this column. But I want to look at WIP, work in progress. So these are actual time tickets. Now, a couple things to note here is that the WIP in your system, in your billing system, is only going to be as accurate as your employees have been dedicated to entering accurate information and entering all of their time tickets. So at this point in time, I'm just taking for granted that all of my time tickets have been entered by all my staff and all the time has been accurately tracked. Now, it's a whole other thing when you start doing the billing process. You may go through and write down some of this for different reasons. That's a whole other discussion. But what I want to talk to you about today with WIP is looking at the total. Now, I'm recording this at the end of January. So I'm assuming that we're at the end of a month. And this is, and all of the time tickets are in, they're accurate, and they're 100% entered as of this point in time. When I'm looking at it, you can look at it one of two ways. So if you take your total WIP, and again, it's just this number, the sum of WIP for all these. And if you take your WIP and divide it by your total annual gross revenue, and this I just got from over here. So again, my payroll, this total income. So that's the 2.6 million. And my WIP is 7% of my total annual gross revenue. The goal here is less than 8% if you're looking at annual revenue. The reason being is 8% is 1/12. I don't want to see WIP being more than 1 month. Ideally, personally, I'm not a fan of monthly billing. If you bill hourly and you bill monthly, there's so much potential for time or for cash flow problems. I recommend either weekly or biweekly billing. And I know that sounds crazy. If you've been entrenched in monthly billing, it gets a little like hard to wrap your head around doing it faster, or more often, I should say, more frequently. But keep in mind, just because it may take you 3 days to get billing done once a month, it's not going to take you 3 days to get billing out every week, because you only have 1 week of time. You worked on substantially less cases over the course of 1 week. So it's a lot less bills going out. And there's filters within every billing system so that you're only working on the bills for cases that have had time tickets for that time period. But if I see WIP and I see this total is more than 8% of annual revenue, I'm starting to get nervous, because it's going to jeopardize, it's going to come bite us in the butt down the road if we don't get this billed quickly and get it collected quickly. So this is a metric that I like to look at. If you want to compare your total WIP on a monthly basis, look at your average monthly. So all I did here was I took my annual 2.6 million and I divided it by 12 to get an average monthly revenue. And again, this is gross revenue, not net profit. We're talking top line revenue. So WIP divided by average monthly gross revenue. And in this example, it's 80%. And the goal is to have less than 100% of your monthly revenue in WIP, because you want to get this billed. The faster you get it billed, the faster clients can pay you, the faster the money hits your checking account. And I want to see you be financially stable. So that's all that I have to talk about today. If you have any questions, drop them in the comments. If you have questions about some type of a ratio or a question you have about your financials that you would like me to answer in a future episode, either send me an email or drop a comment in the comments below, but I'll leave my email in the description to this video. Thanks, and have a great day.